Hello everyone, good afternoon and welcome to my latest webinar. This is me, Richard Perry, Market Analyst at Hantec Markets. Latest webinar I'm going to do is today on Fibonacci. It's a much used but often misunderstood form of technical analysis, and I think it's very interesting to talk about. First of all, just going to go down the old same route as giving you the disclaimer. As per usual, this is going to be here at the beginning, and also I'll show it up at the end, just in case you didn't get the chance to have a look at it. A little bit about me, as per usual, nothing majorly changed since the last one. Worked in technicals for 13 years now in the market, doing Forex majors, equities, and yeah, I just pretty much strongly qualified, and I'm hoping that you think that I'm able to be able to talk to you about stuff like this today. Now, okay, a little bit of an agenda. What we're going to do is usually go through a bit of theory introduction. We're going to look at the relevance of Fibonacci in financial markets, because there's loads of different ways you can use it, and look at the retracements, projections, fans, and arcs. And then finally, we're going to finish off, as per usual, with a look at the markets as they are at the moment. Please feel free to ask any questions you may have. I will do my best to answer them as and when they come up, but if I do miss them, I will try and return to them at the end when we're going through the markets. And if there are any markets you want me to look at, just please give me a shout. Okay, well, straight away, I'm going to start off. What is Fibonacci? Well, it's a mathematical series that actually produces a golden ratio between a number series. Basically, it is a sequence that starts at 0 and 1, and then you basically add up the numbers through the series, and the product is then becomes the next number in the series. And as that number series gets ever greater, the ratio between the two numbers goes to 1 to 1.618. And that eventually becomes, as I said, the golden ratio, which we use in technical analysis. Now, in this slide, you can see the number series, and you may recognize some of these numbers because I talk about them, or have talked about them, as my moving averages that I use as well. So 21, 55, 89, 144 are my favorite moving averages that I like to use. So that's interesting in the fact that they are Fibonacci numbers. And as I said, the sequence just moves higher as you add the two preceding numbers together to make the product, and then yeah, it's that's how it works. Now, you put that into a little diagram, and you can actually get the numbers into a Fibonacci spiral, as you can see in these two boxes here, and the numbers appear in this spiral, and they get ever higher. And the spirals have been found to make natural formations in nature. You've got things like shells, human ear, flowers, also Hurricane Sandy, which was a Fibonacci spiral, and also galaxies as well, spiral galaxies such as our own Milky Way. So very interesting that. And also the fact that the Greeks used it in a lot of their architecture, such as the Parthenon in Athens, and also you can see here even the Apple logo has been used for Fibonacci in its design. So there's a lot of exponents of Fibonacci out there, and is a very popular number series. Now, the question I suppose you probably ask is, what has this got to do with financial markets? Well, if you look at Fibonacci, it considers the recurrence of these patterns throughout life, and I suppose if you're prepared to accept that technical analysis is all about the history repeating itself and the appearance of patterns, then I suppose you're not a million miles away from being prepared to accept the fact that Fibonacci has a part in trading itself. A lot of traders do use Fibonacci for their levels, for their supports and resistances, but also for their targets as well. So it is a sequence that does have a lot of relevance in technical analysis. As per usual, there is a caveat to that, in the fact that that Fibonacci is by no means, and should by no means be, your number one tool of technical analysis. You need to look at other indicators. I always say this every week, but I always go for the rule of multiple confirmation, and the fact that you can incorporate Fibonacci into your technical analysis and use it in conjunction with other support levels just adds to your conviction when you trade. And when it coincides with different indicators, then certainly that just gives you more conviction when you're looking to put your positions on. So that is why we look at Fibonacci with other indicators as well. Okay, so Fibonacci numbers, 23.6 is the first one, 38.2, 50, 61.8, and then you look higher above 100%, which is 161.8. Now, you've got a few boxes here that just describes to you or explains to you how you get those numbers. For example, 38.2, you divide two numbers within the series, or a number two places higher, sorry. So, for example, 13 divided by 34 is 0.382. Again, 21 divided by 55 is 0.382. 34 divided by 89 is 0.382. I mean, you can get the idea that basically that is the basis of your 38.2 Fibonacci retracement. And also here, you notice that 1 minus 61.8 is also equals to 38.2. So I won't go through the other two, but you get an idea that this is how you derive the numbers and the key levels in Fibonacci from the number series. You just have a quick look at the boxes, 61.8 and 1.618, or actually that should be 161.8. That was my mistake. Anyway, so that's how you get the calculations. Now you get that into a chart, and I've got the Aussie dollar here, and you can see actually that I've put in a key. Well, first of all, I haven't explained yet that basically you measure it from a key low to a key high. So anytime you get a key low and a key high on a chart, you can do a Fibonacci retracement. And you can see in this chart of the Aussie dollar that the Fibonacci levels are consistently seen as turning points for the Aussie dollar. Numerous times it actually is seen, and let me just zoom in there slightly so you can see a little bit better that these numbers, they just bear in mind first of all that the Fibonacci is not an absolute exact level. It's more like an area, a support area that you should be factoring in rather than literally the exact number. But certainly you can see on this chart that the retracement levels are used on numerous occasions as turning points, and key turning points is exactly where you want to be seeing the market on this chart. So that's your basic Fibonacci. So how do we incorporate that into our trading? That's my slides. There they are. Okay, so you've got four different ways that you can incorporate Fibonacci numbers into your charts. You've got retracements, you've got projections, you've got Fibonacci fans and Fibonacci arcs. I use retracements and projections a fair bit. Not so much of a fan of Fibonacci fans or Fibonacci arcs, purely because that is, that's how I've traded, and that's how I've used them. I haven't often seen Fibonacci fans or even ever seen Fibonacci arcs, but I know they do exist. So yeah, for your retracements, first of all, you're looking at your bull market corrections first of all. So you basically identify a key low and up to a key high, as I said on that Aussie dollar chart that I just showed you, and then the Fibonacci lines come in at the specific percentage retracement. So 38.2, 50%, and 61.8 are the very popular ones, but also 23.6 is also a Fibonacci retracement that's popular as well. Now, basically, fib levels are initially seen on certainly on bull market corrections, initially seen as the basis of support, but once they're breached, they become the basis of both support and resistance. Just on the old adage that old support becomes new resistance. That's when you're trading between the lines, that is how you need to see it. They are a basis of support and resistance. So let's show you that on a chart. A chart of the S&P 500 here with your Fibonacci level from May 2012, June 2012 up to September. You had a big run higher, and then you could then draw some Fibonacci levels. You can see here 23.6, spot on there for that correction initially. Your 61.8 caught the big low, and if I stick, so you got that one there, your big low at 61.8, and another one here. Pretty much, as I said, don't be caught up in doing them as exact levels. And I've just seen another one here. So you can see that they do get used on numerous occasions throughout this chart. So that's your bull market correction, and then you've got obviously your bear market rallies opposite. So you're looking for a key high down to a key low, and then a retracement of that downside move. And once again, as I said, the opposite. So initially your fib levels are basis of resistance for the rally, but then once you start to push through the fib levels, then they become support and resistance, as old resistance becomes new support, etc., etc. And I've got a chart to show you. So this is Euro. Between October 11 and March, wow, Jan 12, sorry. So you had this big correction here in the euro, and then you start to see these fib levels coming in as your basis of stopovers. So 2 here, wow, 2, yeah. Your initial rally here. Again here, 23.6, absolutely nailed this euro move across the board, pretty much across the board. That slightly did work. You would certainly argue that it was a basis. But once, as you can see, once that support gets broken, then you actually get a retracement all the way back. So that's interesting in itself, the fact that once the key levels gets broken on the downside, you get a move back towards the next fib level. So under 23.6, your next one is 0, and that's the move you had. So that is something you need to be aware of. And I've just seen another one there. Christ, I can't believe I forgot that. So yeah, so you can see throughout this whole chart, I could probably do this all day on this chart, that these Fibonacci levels are key, and you get used, certainly in this instance anyway, as your key levels for turning points in the market. Okay, so next one is Fibonacci projections. Now, the whole point of this is basically, once again you're using all the Fibonacci levels, and you basically measure from we'll start with the uptrend, so it's over here. So you have your move to the upside from A to B, and then you get a retracement back to C, and then on the support of C, the market starts to move higher again, so you can use that as your Fibonacci projection. So you measure from A to B, and then down from C, projected higher. And on the chart, that looks like this. You get your initial move, initial bull run. This is on the upside, on your upside projection. Initial bull run from November 2012 to December, and then you correct back to this low of 129.97 in January, and then you can start looking at the Fibonacci projections. So you put that number in, and then you've got your Fibonacci levels. And I've already marked on here the number of times that Fibonacci levels get used in this projection. So when you start to move higher, you start to think, okay, well, once you break through one level, you should be going to the next level, and then that is a feature. If you start to turn lower, then you correct back, and this Fibonacci, these Fibonacci projection levels, not only do they get used as your initial target, 61.8, a couple of times used as the initial target, but the 100% move was hit almost bang on before it started to turn lower again. And a point that I should use is that your Fibonacci levels, once they have been used, continue to remain in force, and they continue to be seen as a basis of support and resistance. So once you've hit that 100%, you come back down, have a retracement back to that 50 level, bang on, 50 again, 61.8 gets used a couple of times, and then once again, once that 50 level is breached to the downside, you get a move. Look at this, you get a move to 23.6, and then a retracement all the way back to 50, pretty much to the pip, which hit that Fibonacci level, which was 33.18 on the high. 33.21 was at 50% fib, so only 3 pips away from hitting that fib level. So there are, as you can see, Fibonacci projections again get used on the correction back down again. Not only that, not only on the move to the upside, but also on the correction back downside as well. On the downtrend, similar story. The opposite though. You've got your initial move to the downside, A to B, and then you have your Fibonacci projection from the bounce that turns lower at C. So S&P. Oh no, sorry, you got another one on the S&P 500. So this is the second projection that I just thought I'd look at, because I thought it was very interesting and got used once again very interestingly. So you had this June 2012 correction back down to 1342. You could then do the Fibonacci projection higher. 50% hit bang on, 38.2% hit bang on, 23.6, not too far away, but then you had a consolidation, a move up towards 61.8 consolidation, breakout through 61.8, and when you did that, it goes all the way to 100%. Not only that, moved it out, and you get a move ultimately through that 100% level, and it hits 161.8%, almost to the pip, before turning it lower again, and you didn't come far off hitting that 100% again. So you can see that that level gets hit. Does it hit 100? Yes, there we go, 261.8. Wow, again that signaled the top in that phase. So you can see that you can use these Fibonacci levels as your targets, as your upside targets for breakouts. So just scrolling back to here, once you've broken out above 100%, you then theoretically should be starting to move back towards 161.8% as well. So once you've broken out above 61.8, you're moving towards 100%. So it is very good in terms of using targets, upside targets. Okay, so your next chart is, I did a couple on this one actually. This is your downside projections. Your initial move from the key high to the low, and then retrace to that move there. I'll just put a Fibonacci projection in red, because it did sort of get used quite strongly. But then I've got a second one in blue on that second leg here, which also got used quite strongly. So you've gone from the high there to the low, projected from downside from that reaction high. 100% gets hit a couple of occasions, then you start to break through 100%, and then you move to the downside, starting to consolidate around 161.8, and then once you're through 161.8, you're now projecting downside to 261.8. So again, that move, and that was ultimately, this is sort of almost a live chart on oil. This is WTI, is that right? No, that's Brent. Sorry, my fault. Forgot my codes. Sorry, that's Brent. Yeah, you had that move on Brent that hit that 261.8, and we've started to rebound. Interesting. So does that now mean we're going to retrace back towards 161.8? It is perfectly possible. interesting in that regard. Okay, so Fibonacci fans. Now, not trying to sort of make any weird jokes, but I'm not a big fan of this, purely because I don't really use it, although it doesn't necessarily mean it doesn't work. They basically, you have the move measured again. This is on upside, so you're retracing a bull move. So you move from A to B, and then you basically measure the vertical distance from B back to A, and then you do your retracements on that, and then through that you spread the fans out from A. So let me just show you that on a chart. Chart of the euro. Okay, so here we've got a low in the euro, peaked out here on the in mid-September, and then basically you measure the vertical distance from that September high back down to the low, and then your Fibonacci fans spread out from that first initial point and then cross through that through the projections. And the basis of this is that you'll be finding support and resistance around those Fibonacci fans, and it does to a certain extent work. Not amazingly, but I mean this one does work reasonably well on the euro. A couple of levels there, a consolidation through these two fans here, and then once you're back below the 61.8, you start to use that 61.8 as the basis of your resistance through this, and then you start to pull away. So theoretically, as I said again, once you start to break down below the 61.8, you should theoretically be coming back towards 100% correction. So, I mean, I don't know whether that is ultimately the aim of Fibonacci fans, but still, you've actually got a second one on this chart that I've sort of drawn in. Again, you've got your move from your low to the high here, and then you project through those Fibonacci projections, and they do work pretty well again. Not too bad on this one. 50% worked pretty well on several occasions actually, and then also the 61.8 works pretty well, and then you start to break that down again, so it becomes the end of that. Now the final Fibonacci move is on arcs. Now I haven't got the capacity, strangely, on my Reuters system to do Fibonacci arcs. However, I believe, and I have had a look at MT4, and you can do the Fibonacci arcs on MT4. So you're at a bit of an advantage over me on this one, because I can't really show you an example of a Fibonacci arc, but I can explain it to you, because basically it's the same sort of concept as Fibonacci fans, where you have from a low point to a high point, but this time you're doing your Fibonacci, effectively you're using the high point as a compass point, and you draw your retracement arcs through those points on the baseline, which is this this diagonal line. And then again, the whole concept is that these Fibonacci arcs will be the basis of support and resistance. Again, I'm not a massive fan of that, purely once again because I've never used Fibonacci arcs in my trading, but who's to say they don't work? But it's probably worth mentioning. So, okay. So basically, in summary, we have Fibonacci's for certainly in retracements. You can use them for entry points, profit targets, the basis of stop losses, and then again for projections. Again, they become breakout targets and future market turning points. Now, what I wanted to do was now show you a quick hourly chart, because Fibonacci does work obviously on different time scales. So this is the hourly chart on cable from a key high to a key low. This is a projection measured downside, and again it does work pretty well on this. I mean, I won't waste time doing all these turning points, but I think it works pretty well. And you get 100%. There you go. So once you're through that, actually you don't get the immediate move, but you do ultimately get the move back towards 100% on the downside. And that 100% becomes a basis of very strong support actually, and then subsequently basis of resistance. And then once you're through 100%, you go to 161.8. So that gets, and that 161.8 as well becomes the basis of support on a couple of future occasions. So again here, and now I remember the the reason why I wanted to show this, because basically you roll this forward, and I've been talking about 1.602 as the basis of support on the cable, and let's see where it is. I think that is a very good basis of support. 1.6, and you look at it on numerous occasions gets used. 1.602. So my thinking is that if cable goes through 1.602 and starts to trade below it, then it's in pretty much big trouble again, certainly pulling back towards these lows on the chart. So yeah, that's cable on an hourly basis. Now, there was another one I wanted to show you on an hourly chart, which is JPY. Yes. Okay, this is Japanese yen on an hourly chart. You had the big high at 109. This is the recent move actually. This is that big correction that we've had in the yen in recent weeks. Big move from 109.90 down to the low at 105.18, and the Fibonacci levels are pretty decent. And the fact is that you've now broken out above the 38.2%, so you should now move back towards 107.54. Now again, I'm going to talk about the fact that 107.50 is this key level of resistance, which was old support in the downtrend becomes new resistance, and I think that is the key level on this chart, 107.50. If 107.50 remains intact as a resistance, then I think that the outlook is fairly mixed on dollar yen. But if 107.50 starts to trade above 107.50, I think the outlook is suddenly once more improving, and it's a medium-term buy signal. And I'm going to bring in more technical analysis here. You've got the potential through 107.50, which is a big neckline of a big head and shoulders reversal confirmation. If you get that, it's one shoulder there, big head, second shoulder. So if it moves through 107.50, I think you're then starting to think about a big full retracement, probably back. Well, certainly initially, if you're going to go on fib, you start to think about 61.8, which is around that 108.10. But then subsequently, I think with this power of this big base pattern, which it could well turn into a big base pattern, not by any means confirmed yet, but the move through 38.2, which is around 107 figure. Again, 107 figure has been a basis of support and resistance. Big basis of support on a couple of times, and basis of resistance having broken through that today. I think that we're now going to be coming up and using that as support for 107.50. So the outlook for dollar yen still mixed, but is not a million miles away from turning dollar bullish once again. Okay, so this is what I wanted to show you as well. This is dollar yen, and it is surprising, or maybe it isn't surprising, how the fact that dollar yen on a lot of my chats, my webinars, has been probably the one forex pair or instrument that you trade that has been used on so many occasions as an archetypical textbook example. Now that, I don't know whether there is something in that, but the fact is that dollar yen, I think, is an excellent exponent of many technical analysis indicators, so just bear that in mind. Now we've got here the basis of your Fibonacci projection once more. So you've got the key low October 2013 down up to the high, and you start to put in your Fibonacci projection from this key low at 100.74, and look how many times red circles here, how many times the Fibonacci level at 23.6 initially, but then 38.2% comes in, 100% here, 23.6, 23.6. Now if I move this on, once you get through your 50% projection, you go very quickly through 61.8, and then you absolutely nail it up towards 100% projection. Now that is interesting, because once again, once you've broken through the fib level, you then go to the next one, 100%. You've had a big correction, and the old Fibonacci levels on this projection have been excellent as the basis of support in the last couple of days, 3 days. The big spike low, 105.18, is back to that 50% line, 105.19. The low yesterday was 106.22. The 61.8 level is 106.23. So these two Fibonacci projection levels have worked absolutely supremely in this Japanese yen chart, that is certainly going to be the basis of support. So 106.22 or 23 on this on the fib level is holding as a basis of support. So you'd start to think about the fact that the bulls are not a million miles away. Once again, the dollar bulls are not too far from gaining control once again in this chart, and that is that's very interesting, I believe. So just back on the slides very quickly, a couple of things, just really looking at how to trade Fibonacci. First of all, I'd say don't trade too soon. Wait for the confirmation that the Fibonacci levels are actually in force, because if you just assume the Fibonacci levels are going to take control, then it's a little bit wishy-washy. I would rather wait for confirmation that those Fibonacci levels have been vindicated and validated before you start thinking about trading. And certainly if it coincides with support, as I said, or resistance, or on that sorry, I'm talking about going long. So if a Fibonacci level coincides with a key support level, then that just increases the trading conviction around that level. So basically what you do is once you have seen the Fibonacci level come in as a basis of support, you can start to think about placing an order. I did say that once you see a Fibonacci level start to take control, then quite often you'll see the price move towards the next Fibonacci level, and what you can do therefore is just place a limit order, maybe between the two Fibonacci levels, not on the Fibonacci level, because you might not get a retracement back to it. So you could place a limit order between the two Fibonacci levels, and then maybe have a target of the next Fibonacci level higher, and have a stop loss perhaps below the low of the recent correction. So that is one strategy you could employ. Now let's have a quick look at where these Fibonacci charts are at the moment. Okay, we've had big corrections in these equity markets, so I thought it'd be interesting just to see where they are. FTSE is bang on 38.2% at the moment. Now 38.2%, interestingly, coincides pretty much almost exactly with these two levels of support, with these two levels of resistance here. So that could be that it could be a bit of a turning point on the FTSE, coming up very shortly. Interesting here, look at this key resistance up at 60. God, my eyes are rubbish. 65.88 hit pretty much bang on that 60 is pretty much bang on that 61.8% level. So that is another key resistance now. So that is something to look out for on FTSE. So let's just do DAX. This is your DAX one. Again, the DAX is up at its 38.2% today. no major resistances, although you'd say arguably that reaction high at 9140 is coinciding with the 50%, so not a million miles off that. So if you get back above, if you start to see a close above 8940, which is 38.2, 89.42, if you start to see a close above that, you can suggest that we're going to be coming up towards the next fib level as the rally goes. Let's look at .spx, because I know that's a long look at that. Wow, it's absolutely smashed the recovery in the S&P 500. It's now even back above the 61.8% fib level, and again, if that, I mean, it didn't even think about it. It just absolutely nailed it. Didn't even think about stopping. You might see a bit of a consolidation around here. In fact, you've got a bit of a quiet, so far, a bit of a quiet day, so maybe there is a stopping point around this level. Yeah, maybe there is. But if it starts to trade significantly through the 61.8 level, I think you're then certainly in the realms of 100% retracement back towards that key high again. Okay, let's look at Euro. Did I do one? Okay, let's zoom out. Here we go, Euro. Wow, look at that. 23.6. Interesting. Now, remember this because this is a feature in some of these Forex pairs. 23.6 hit pretty much quite nailed on and fallen away. So that is your big resistance initially. Interesting that it coincides with that level there of 28.58 as your low. Interesting. GBP 23.6 once again being hit as the basis of resistance in this rebound, almost to the pip on cable. That is, yeah, that's interesting. We've done dollar yen already, but I'll do it anyway. Just zoom in slightly. This dollar yen recovery is actually doing all right. It's actually doing okay. Yeah, it's sort of midway between a couple of fib levels, 38.2 and 50%, but certainly it looks like it's more bullish, certainly than the euro dollar and the cable chart. Have I done any others? Oh yeah, yeah. I mean that's Aussie dollar from that retracement of the big move. It's sort of consolidating. It's not really doing a great deal. It's pretty messy, I would say. I know a lot of people have classed this Aussie dollar chart as a diamond, formation. And when I say diamond, I'll draw the diamond very quickly for you. So you do that. Oh, crikey! There you go. It's a consolidation pattern, really, and you've had no breakout yet. It's just a diamond consolidation pattern, so a break to the upside obviously is bullish, break to the downside is bearish. It's your basic consolidation pattern. Yeah, I mean, it's not really telling you a great deal because you're not really breaking out, but you could argue that it's a bit of a symmetrical triangle going on, and we'll see how that moves. But yeah, Aussie dollar consolidating, not doing a great deal. But I mean that 23.6 isn't really doing a great deal there on that one. Now Kiwi again, look at that, 23.6, nailed that rally there, and it still is doing a job here as the basis of resistance. So you're not really getting a solid move above your 23.6 level, and yeah, it certainly looks like once again 23.6 is your initial resistance there. How did I do Swissy? It would help if I could spell. No, I did not, and the reason is because sort of the opposite chart is. I mean, interesting. I did a chart of. I'll show you just now. Here we go. This is just as an aside. Anyone who's interested. This is Swiss franc and euro. The euro sort of inverted. Look how correlated those two are. Basically, where the euro moves, the inference of this being that what the euro does, in terms of what euro dollar does, dollar Swiss does the complete opposite. And once again, I mean that is one of the most correlated charts I think I've ever seen. So euro and Swissy move basically hand in hand. Anyway, oh, whoops, get that back. Where has it gone? Okay, Swissy. So let's just do this live for you anyway. Why not? Where would you do that from? Well, you'd probably do it from this one. Yeah, it's not really done it. It's not really helped a great deal there, because the move through 23.6 should theoretically come back towards 38.2. But you've seen a big turnaround in that. Yeah, that's a bit not. It doesn't do a great deal for the chart, really. But I suppose you'd argue that 23.6 did hit that initial rebound here. So yeah, interesting. Okay, well that sort of brings me to the end of my chat on Fibonacci. Now what we can do is, I've actually done it completely wrong. Let me just quickly sort these charts out for you and give you a proper chart update. Oh no, what have you done there? Okay, here we go. This is, no, let's have a look at cable. Yeah, I mean that cable downtrend in there, big downtrend, is just slightly pushed above the breakout of the downtrend, but it's sort of now corrected back into it. 1.602 I think is that key level, as I said, and that's pretty much been hit to the pip, not a million miles off it. It's just slightly below it today, but bounced off it. You'd look at these momentum indicators on this chart. I would say that it continues to be in negative configuration on the medium-term outlook. RSI just falling away again. MACD lines consistently under neutral, and also stochastics turning lower again. So that is a real concern of mine. And I think certainly if there is a move back below 60.20, I'd be really concerned about this coming back towards the test of these key lows again, because just the momentum indicators across the board are pretty bad. Okay. My chart has frozen again. That's so annoying. Right, well I can just, there you go. Happy days. Let me just wait for that, sorry, very quickly. Please respond. Please respond. Okay, come on. Well done. Right, euro. Again, similar sort of story. Now these retracements that I've got Fibonacci levels are actually of a massive bull market correction, big bull run correction there that we had on that is euro, and we've now broken back below 61.8, and as I said, 61.8 is generally being used once again as the basis of resistance. It doesn't look good, and if we're going to go on what I said earlier, in terms of once you break down through a Fibonacci level, you tend to move to the next one. maybe you can understand where I'm getting with this, but we're probably going to be coming back towards 120.40 now as a full retracement of that move. Obviously, the initial test would be $1.25, but I think the likelihood is that we're going to be pulling lower. And looking across the board at these momentum indicators, they would agree with you. MACD, MACD line is consistently below neutral now for the past, 4 months, 5 months. Not looking good. So yeah, that is not looking happy. And today, once again, we've rolled over. 126 is the near-term support you need to be looking at, because that is your reaction low within this move. $1.26, but certainly I think it looks increasingly as though this move is losing steam. Certainly if you lose 126, you're back at 125, and I think if you lose 125, then it's curtains for the euro once again. But Draghi would be happy with that, so he'd give himself a big pat on the back, I'm sure. Right, Japanese yen. Now, as I said, Japanese yen is interesting. So what do you do with it? Well, it is sort of midway between all these fib levels, which is fine, but I think that the fact that these momentum indicators is fairly neutral. I've been talking about this big medium-term buy signal of the stochastic crossover. Now that's your first signal. I'm concerned that we haven't broken. As I said, that's 107.50 level. I think is key on this chart. 107.50, 107.49.49. So let's say 107.50 for good measure was the reaction high within that big bearish outside day. Now we haven't ever retaken that level, and that gives me a little bit of concern. So that Fibonacci level is still in my eyes a bit of a concern. And I've actually got the Fibonacci retracement from 110.08, which was the ultimate high. But on that chart in the discussion, I actually did it from the other high. But you get the same sort of levels anyway, so it's not too far off it. So yeah, I think dollar yen a little bit of a middle of the road phase. Actually, these momentum indicators sort of still factoring in what they're trying to do. The first bull signal has been seen, which is the stochastics crossover, but certainly the MACD lines are not doing a great deal yet. RSI sort of flattish as well, around that 50 points. So there's still a lot more to be done to the upside, and I think that signal would be, the bull signal would come with a break above 107.50, which is that reaction high there, and also the fib retracement level. So I think that that's what I'm waiting for. And until we see that, I think dollar yen is going to be a bit sort of wishy-washy, moving sideways as it has done in the last couple of days. Big spike to the upside, corrected back. Big spike to the downside, corrected back. You've had a move upside back above 107, but not really any considered move yet on that. Okay, so let's do Aussie. I sort of put in a bit of a base pattern potential here. One at 89 as the potential for a big double bottom, which is interesting. These momentum indicators are just recovering still, medium-term recovery, although it could well just turn out to be a bear market rally. And unless you get that breakout above 89 figure, I think that these momentum indicators are going to struggle to really turn around. So I think that would be my concern for this chart, is that if you don't get a break above 89 big figure, then you're not going to see an improvement in these momentum indicators on a medium to longer term basis. And I think it'll just end up being rolling over once more and projecting back to the downside again. And we'll go Kiwi. Yeah, this Kiwi chart, look at that downtrend. Still in this downtrend phase, and the momentum indicators are just still in this bearish configuration. You've had the crossover on the MACD, and obviously the stochastics are up in sort of positive territory, but they're sort of rolling over once more, and the MACD lines are actually still below neutral. So you're not massively positive. Certainly being underneath that big downtrend as well. Although you had a spike higher in the last couple of days, but actually a correction back lower again. So I think there is still scope for this downtrend to still be in play here on the Kiwi dollar. And finally, let's do the indices. Oh no, sorry, let's do gold. Wow, I've forgotten gold. Yeah. Look at this gold. Wow, I like it. 1240.60 is the breakout, because you've seen 3 days early and late last week, early this week, 3 days in a row of failure at 1240.60. We've now seen the break above it, and we've seen a whole trading day above it, which is a bullish signal. You've also seen today a move back towards that breakout level, find support. So I think that you look across these momentum indicators, stochastics are now nicely settled above 80, which is a bullish scenario. MACD lines are starting to just come back towards neutral, maybe pushing above neutral. So I think that initially we're going to be coming back to maybe we're going to be using, I think, dips as buying opportunities on this. You've got to support a couple of times actually. 1260 is a bit of an old support there. That one there, and a couple of occasions on this. So you'd say 1260, and then I think 1280 is your main level of support, and I'll tell you for why. Sorry, resistance, main level of resistance, and I'll tell you for why, because it's been used on numerous occasions historically as a basis of support and resistance. Resistance there, support, and it's now become resistance. So that is where you are. Also, look at these moving averages as well. Interesting that we're now starting to play around with the moving averages again, which is, we haven't really seen the moving averages in play at all on the gold price for a while because of the strength of the selling pressure. But certainly now we're going to start to come into contact potentially with this downtrend here, which was the bearish downtrend channel, top of that bearish downtrend channel. Also, we're looking at starting to play around with the 144-day moving average, and if anyone who looks at gold on a long-term basis knows 144-day moving average is a big indicator on gold. So a couple of things there that we need to be concerned with, but I certainly think that this move above 1240.60, if it now uses that as support, I think we could be in for further upside towards 1260 and then 1280. Now silver, on the other hand, is not in a bullish scenario at all. Look at that. The disappointment you get from silver is amazing. 18, like I've drawn this resistance in 1860 because 1860. Do you remember that on that gold chart we talked about 1240.60? Now the equivalent on silver is 1860, and where is it? It's 1718. It's just such a bad performer. It's still in this big downtrend phase. These momentum indicators are very weak. The RSI has just fallen over again at 45. That would suggest once again that is just unwinding this bearish phase. Consistently falls over around that early 40s area. Stochastics also turn lower. So I just think, yeah, once again, silver. But the thing that would concern me with that is that the underperformance in silver theoretically has a bit of a bearing on gold, because obviously they're both precious metals. Silver more of an industrial metal than gold is, and has multiple uses, but still silver is silver, that would have a bearing on gold ultimately. But I mean, the gold, having said that, the gold silver ratio is still moving strongly higher, so maybe gold has the potential to just hold on to its gains, but silver looks to be under big pressure because it's just not taken part in this recovery whatsoever at all. So that is that's not great. And finally, let's look at the oil price. Oh, why can you not spell? Okay, Brent. Yeah, I mean, that's just unwinding this huge, huge bearish outlook. I mean, just ridiculously bearish on Brent still, but it's just unwinding some of that move really. Look at these momentum indicators. I mean, you'd say that it's stochastics. I mean, you've had a cross and back above, but to be honest, it's just bumping along the bottom. It's not. I wouldn't class that as a buy signal. Close to a crossover on the MACD lines, however, and I suppose you'd argue also the RSI is close to unwinding through 30, and you would argue also on the RSI that you tend to see the moves back towards, interestingly, the mid-40s, and yeah, so there is potential for further to unwind in this RSI. So maybe there is further unwinding, maybe back towards the downtrend, the old downtrend resistance. Let me just get that and just do that, which sort of is the old downtrend channel that we've got there. So maybe the underside of that old downtrend channel will start to become resistance once again. But certainly it looks like a technical rally, let's just call it a technical rally, is underway on the oil price. Anyway, okay, so, okay, oh yeah, oh, God, I missed a slide off. Silly me. Okay, yeah, a couple of tips really. Just in terms of your fib levels, I would say keep your old Fibonacci levels on your charts, basically because they do have a tendency to crop up once again as acting as support resistance, and as I said, when they coincide with key levels, then this just increases your conviction. You need to be clever with your key highs and lows and where you measure your Fibonacci levels from, because just don't do it from just random little lows and highs here and there, just because it's just, to be honest, it reduces the effectiveness of it. And I stress once again that Fibonacci should be used as a complementary tool of support resistance in conjunction with other indicators. So thank you again for watching today. There is the PDF on the website that hopefully you will find of use. My Twitter handle is @HantecRich. I'm perfectly happy to engage in conversations with people about markets and enjoy it. Any comments or feedback you may have on today's webinar, you can email me on marketing@hantecfx.com. If you've got any queries about markets or anything like that, please email me and I will get back to you, and we can have a bit of a chat. No problem at all. I don't mind doing that for you. And I will leave you with the disclaimer as per usual. So there it is for your information, and thank you very much for listening today and watching, and I hope you found it interesting, and I will see you soon. Thanks a lot.